Hey everybody, Carl Schilling here with you once again, and we are back for part two of the basic life insurance primer. Now, if you remember part one, we went over the history of life insurance. We went over some of the important needs of life insurance, and we discussed term insurance. And as simple as term insurance is, it still gets totally miscommunicated and misunderstood, and we went over some of that. So today I'm going to discuss with you permanent life insurance, okay? And this requires a little more depth, let's say, okay? It's a little deeper, but really not hard to understand. And yes, it has been totally deconstructed and misconstrued and certainly miscommunicated, not just by people outside the industry, but by people who are supposedly professionals inside the industry. Even they have managed to somehow make this way more um, non-transparent and non-understandable than is necessary. Okay, so really, it's let's go over some of that and make you aware of just where the importance is and how things kind of roll out here. Okay, all right. So on permanent life insurance, let's just get our slideshow up. We talked about human life value, single needs, and everything last time. Term insurance. Now we get to permanent insurance. Okay, so permanent insurance, commonly referred to as whole life. All right, so you have two sides of this. The whole life side of it is basically a guaranteed product. It's locked in. Your premiums are locked in, and whatever, as long as you're paying your premium, that amount of death benefit is going to be paid out. Okay, unlike the term insurance, which at a certain period of time will run out. So, but you have your stock company versus your mutual, and this is where it gets a little different. So, you have what's called participating and non-participating whole life. Now, in your stock companies, that's always non-participating whole life. And on your mutual companies, because it's owned by the policyholders, mutual companies declare a dividend, and I'll explain what that means. So, all policies, participating or non-participating, have what's commonly referred to as a cash value. This is something that is constantly miscommunicated. Okay. So cash value is a pretty simple thing. As the cash value, you have what's called net amount at risk. So you're paying premiums, and the day you pay your first premium, let's just say that you're paying $1,200 a year for $100,000 worth of coverage. We're just making an example. Okay, so you decide you're paying monthly. So you pay a little more than $100 a month because they charge you a little more to pay monthly as opposed to paying annually. So let's just say you're paying $100 a month. And basically, the minute you hand a check to the insurance carrier has now guaranteed that upon your death, they're going to pay $100,000. And there's a lot more going on inside that policy. So depending on when you die, it could be a lot more. But let's just go with the basics. So you hand the money, $100. Company now has to have in reserves, protected and available, not some form of debt, okay? Not some form of a liability in that sense. They have to have $100,000 in case, God forbid, 5 minutes after the contract, you passed away. They'd have to pay your beneficiary $100,000. So where does the cash value come in? Well, actuarially, the company has designed a premium, and part of that premium is obviously paying for the death benefit, and part of that premium the company is reestablishing back as a cash value. So the longer you live, the more the cash value grows and gets closer to the death benefit. And think of it in terms of almost an endowment. It's not technically an endowment, but it's the same concept. Okay. So what's happening is the longer you live, the closer you get to dying sooner, later than sooner, but you're living longer, your cash value is growing. So as your cash value grows, now the cash value is available to you, but that is lowering the net amount at risk for the insurance carrier. So basically, the insurance carrier is taking more of the premium and putting it into cash value, okay? And that's their way of offsetting the future liability of the death benefit. So now, if you were to borrow that cash value, which is it's your you can do that, but if you were to borrow that cash value, then it would net off of the death benefit. So, argument's sake, let's say all goes well and you live a long time. So, say you're closing in your 80s, you got this $100,000 contract, but when I get to dividends, you'll see why it's more. But you got this $100,000 contract, and let's say you got $80,000 in cash value. Okay, that's grown over the years. So, the net amount of risk for the insurance carrier is now $20,000. And that's what they're going to pay out because the cash value is going to stay with them. And you get people like Dave Ramsey and other people who suggest that you should have your cash value and your death benefit, but that makes no sense whatsoever. Okay, no sense at all. And it's totally illogical and it's totally against the grain of how the actual contract works. So you must remember that the insurance carrier is putting in reserves from the first day this amount of death benefit. You're paying pennies literally on that dollar. And basically, as you live longer, you start to benefit from the accrual of cash value inside the contract. And you also start to benefit from dividends if we get to the dividend side. And now, dividends is where your cash value per se, just a hardcore cash value, it's never going to be more, okay, um, than um, than obviously the premium you paid. Okay, your total premiums are still going to be greater than the cash value, right? Which makes sense because only a portion of your premium is going into cash value. However, with dividends, a dividend from a mutual company, a dividend is a form of a repayment of based on the company's success, a repayment of premium you paid. Okay. So let's say the company declares a 5.5% dividend for the coming year. So what they do is based on the premium you pay, you get 5.5% dividend, and that goes on top of your cash value. So now your cash value and your dividends are in the same pool. But you'll see them when the proposals come out. You'll see there's a column for dividends. You'll see how fast that's growing, and then there's a column for cash value. Cash value is actuarially set. It has nothing to do with experience. It has nothing to do with what happened that year. There's no ups or downs. It's a fixed amount based on the age that you apply, the age that you are contracted, and the age that you're moving towards every year, closer to the final event of the end of life. Okay, so on the dividend side, you have options on what you want to do with your dividend. Most people will take that dividend and put it in what's called paid up additions. Paid up addition. So when your dividend comes in that year, so say your dividend is $200, argument's sake, right? So that $200 is in paid up additions, which buys a little tiny unit of life insurance. So the dividend's now compounding on the dividend, and now there's more cash value because that little unit has a cash value too. So the cash value is growing, and now on the other side, your death benefit goes up. Your death benefit goes up by that little amount of death benefit that was purchased with the paid up addition. But over time, you are compounding two things. You're compounding cash value and you're compounding dividends. So somewhere around the seventh to ninth year in any whole life policy, you cross over, which means you now have more money in your contract than premium paid. And every year that you're paying your premium from that time on, that day on, it's going to continue to grow. And this is where substantial cash starts to grow inside a contract. Now, that liquidity is always going to be available to you at any given point in time. Whatever is available based on cash value and total dividends combined, you can borrow that tax free. Any loans you take on a policy will have an interest rate, okay? And basically, with a company, you've got two types of dividend. recognition. You've got non-direct and direct recognition. Non-direct is what you're looking for because what it means is, say you have 100,000 in cash value in a policy and you wanted to borrow $20,000. You borrowed 20,000, that would leave you 80,000 in theory in your cash value. Your dividend would only then be against what's existing in cash value and dividends. However, with non-direct recognition, that 100,000 on paper is how your dividends are your dividends are credited to the policy. So the loan is never netted out of the cash value, right? That's a big difference. So you basically still have $100,000 for crediting purposes. Okay. You don't have 80,000, 100 minus the 20. Now, when you have that $20,000 loan, there's an interest rate the insurance carrier is going to charge you on the loan. Every year, you should at least pay your loan, your interest rate, so your loan don't grow. But your loan is a non-recourse scenario. One's tax-free, but it's also non-recourse, meaning that you don't have to pay it back. It'll come from the death benefit. At the time of death, it'll be minus off. So the contract will net back. And that's where the cash value comes into play once again. Okay. And that's the net amount at risk. So the carrier is protected and you're protected. All right. So whole life insurance comes in single pay. You can pay, there are ways to um, um, uh, pay one big payment and purchase the contract and never have any other payments. And the same internal things go on. Okay, every year it still goes on. Everything internally I just described to you goes on no matter what type or what flavor, I like to say, you take. Now think of this in terms of almost like a mortgage. It's almost like you're paying off a mortgage because you're getting this guaranteed money, this future income that you may or may not be here to earn. You're getting this guarantee that the insurance carrier is going to make your family or your business or whatever purpose, they're going to make them whole by the death benefit, okay? And that death benefit is available day one if the event happens. So basically, you can get this in the different flavors. You could have a 10 pay contract, which means you're paying now. The premiums are going to be higher in the shorter period of time. Makes sense, right? It's like anything else. So you got a 10 pay, you got a 20 pay, you got a pay till 65. Some companies, non-participating side, have pay till 85. Um, but there's some things you need to know about a non-participating contract. So before we leave, let me make sure I make that clear. In a non-participating contract, because you only have cash value, you never have dividends or any other accrual of any other gain. Not, and by the way, I shouldn't use the word gain because none of this is a gain per se. So here's the deal. In a non-participating contract, in theory, the longer you live, you could ultimately pay more in premium than the death benefit. And that's the problem with a non-participating contract. That's probably why you should stay away from them, even in the smaller worlds of 5,000 final expense. Non-participating contracts, you want to live, obviously, but the longer you live, you're still getting that small cash value, but that cash value is kind of meaningless in that sense that you could borrow a little bit of it, and that's fine. It'll come off the death benefit. But you could get to the point, like say you live into your 80s, in 90, you could get to the point where you paid more in premium than the death benefit, which would make no sense whatsoever. So when you have a non-participating contract, you got to watch that. The closer you get to paying as much as the death benefit, you might as well get your cash value at that point in time because the cash value, probably is better, and you continue to make the same premium payment in the bank. You just put the money away for yourself. There's no reason to give it to the insurance carrier once it crosses the death benefit or gets very close to the death benefit. So that's a big issue in participating or non-participating. So understand that. Make sure you always ask that question. You're talking to someone, well, is this policy participating or non-participating? You probably want to stay away from non-participating more than likely because that one structure could happen to you. Now, on the other side, permanent life insurance, we have the thing that started in the early 80s where insurance carriers, there was so much talk, and we'll get into this in a little bit. There was so much talk about comparing investments, and the old theory was buy term, invest the rest. And basically, people, why would I put money in a whole life contract when I could just buy term insurance for a lot less and invest in other things? And then you got to the comparison, which is always wrong. Never get involved in that. The comparison of life insurance to an investment. It's not. There's no comparison. There should be no comparison. Life insurance is a totally unique asset, has nothing to do with investing, but we'll get into that later. So they created this blended product. So they created something called Universal Life. So Universal Life started coming out in all kinds of flavors. It was interest sensitive, interest paying, all kinds of UL policies. So the industry in the 80s, they started coming out with this. Now, UL overall, the premium would be more flexible. The premium was not fixed. So you had this range of premium. You could pay, it was always going to be higher than term insurance, but you could pay a premium that could just kind of hopefully carry, they give you the based on the interest rate and all, they would give you a premium that should carry your death benefit. However, there's no guarantee. There's no guarantee. So while it's flexible and that's wonderful, there's no guarantee, which means at some point you could come to the point where you have to pay more premium in order to maintain and keep your death benefit. And that could come at the worst time possible. Okay. The next generation of UL, and they still have UL, by the way, there's all kinds of UL. The next generation, which came out, I'm guessing, maybe a decade or so, but IUL, Index Universal Life. Now, in the base universal contract, it's real simple. They charge, when they say there's guarantees, they're very limited. The guarantees are very limited. It's not like the whole life. The whole life, other than the dividend, the whole life is totally guaranteed. The amount of the premium, the amount of the death benefit, everything is fixed. The dividends are the only non-guaranteed portion of that contract. Okay. Everything else is totally guaranteed. On the UL side, there's really no guarantees. What happens is it's just a simple, think of a funnel, think of a little funnel. What happens is on one side, you pay a premium. That premium pays for the death benefit based on an annual renewable term, the least expensive term. But over time, the longer you live, the most expensive term, because every year you get older, that term premium increases. So that's an increasing cost every single year. By the time you get into your 60s, that is a very substantial cost, way more than whole life at that point, had you got whole life, back in this same moment. So you'd be paying way more than a whole life premium out into the future the longer you live. So what happens then is they take that money and the difference, what's left, because the term policy goes for the expense of the death benefit, and then they take out some expenses based on the administrative cost and some other things that the company has, some fixed expense. They take that from the premium, and the remainder of that premium, which historically is the same thing the cash value is in the whole life, but the remainder of that premium goes into a little bucket. Now, that little bucket is either getting a interest rate that has some kind of fixed interest rate in a UL, and it has some kind of projected interest rate. So you're going to get the growth based on that interest return. That's interest sensitive, and that's an interest rate. On the IUL, it's all the same. The whole mechanism is the same with one exception. The return or the gain, and in this case, it really is a gain, the gain on your little bucket is being done through an index. So whether it's the S&P or you choose an index or whatever index you choose, there's a participation rate. So that money that flows into the bucket is now getting the return based on the return of the index. Okay. And the index at that point, say it was the S&P, say the S&P had a 12% return. We'll make the math easy. Say it had a 10% return. You had a 75% participation rate, you would get 7.5% credited into your bucket for that year. Okay. So that goes on every single year, every single cycle. And then ultimately your cash values are growing. Okay. it's as I said, it's got really um it's the industry's version of buy term and invest the rest, realistically. That's really what it is. And guess what? There's no either or here. The products are I think for me, as a person who counsels clients and works with clients, I try to find what they want, what their sensitivity is, what do they really feel is most prevalent for them. And I do think that in the business market, select market and businesses for business owners and for certain types of protection that businesses want to create, IUL is a pretty good deal, all right? Because IUL won't have the same upfront expense factor, and you may not be too concerned with the long-term effect of it because it's got a business purpose to it, okay? Okay, so here's the big mistake for all that. Everybody says mistake is the first step of success, but the real fact is correction of the mistake is the first step of success. So here's the big mistake, and it's done by people, consumers who are not that familiar with everything. It's done sadly by the industry itself internally and salespeople, and it's done by outside talking heads and so-called financial advisor literature, magazines, financial advisors themselves. Here's the mistake. Life insurance is not an investment. Let me say it again. Life insurance is not an investment. It should never be compared to an investment. However, it is a unique asset base that does things that no investment can do. Okay. And we'll show you what that does. This financial tool does a magnificent thing that no other investment can do. Okay. It's a unique asset base that creates tax-free liquidity, immediate tax-free liquidity. No, not dollar for dollar. Of course not, because somewhere the death benefit has to be factored in, right? Um, it creates tax-free liquidity for chronic, critical, and terminal illness. Totally separate option, has nothing to do with your cash values or any of that. No, it's simply an acceleration of the death benefit. So that death benefit, that overall big number, can be accelerated based on a need for chronic, critical, or terminal illness. In its own sense, it is a catastrophic health protection. You could have lower level health insurance and have a lot of your life insurance through the death benefit taking care of catastrophic health issues, cancer treatments, heart attack, stroke, these kind of things, diabetes, ongoing, right? Terminal illness, going to die within 12 months. You can get almost 100% of your death benefit up front if that's what you wanted to do. Okay. And of course, there's a percentage of death benefit that would go to you in these other cases. It's not always 100% of the death benefit, but that again will be shown to you whenever you're sitting down and you're going over a contract. It creates tax-free income. It's one of the great tools. There's nothing mutual bonds, municipal bonds rather, municipal bonds and some other factors and some other types of bonds might create some tax-free income, but nothing like the tool of life insurance. So you can develop strong tax-free income for retirement at the end of life, whatever you want to do. Okay. It creates tax-free generational wealth. This is what wealthy families have always known. Families with big estates, families with protective estates. These people have used life insurance as a tax-free way to pass that estate down to their heirs, to pay off whatever tax liability the government wants to take back from them. So they're passing a full estate back. And that's a tax-free transaction. Okay. So really what you're doing here, life insurance is protecting future income. It's the income of your human life value that you may not live long enough to earn. And that income is going to come back to your family, the business, whatever concern it is, that future income is being protected. That is the risk transfer. That is the tiny check that you write to the insurance carrier for the big check they would write back. And as you live longer, the big check shrinks and your little check grows. So you live a long and healthy life. You live to, say, 100 years old. You're right there. Guess what? You have switched places with the life insurance carrier. They now have the small check. You now have the big check. So that is really about the core of that aspect, and that's generational wealth. That passes generational wealth. It's if you're insured for 5, 7, 10 times your income, and something were to happen, your family's going to receive generational wealth, not just the future income. Okay. So we went over some of this, but how does it work? As I mentioned, premiums are actuarially designed. Okay. So it's an actuarial number. It's fixed. It's not something variable. It's not something that just willy-nilly. It's fixed amount. It's guaranteed. You know it's there. Cash value is pretty much what I like to call the endowment part of the portion of the contract. You're almost the longer you live, the greater the cash value grows. Soon, the net amount at risk to the insurance carrier is lowering, and therefore you're starting to receive the benefit of living longer. Okay. Dividends are a return of premium and thus not a gain. So, there was talk about, this trying to gain, tax unrecognized gains, right? And then they said only for billionaires. But if the government says one thing, it would be for everybody ultimately. But if they were ever to tax unrecognized gains, all the money in your life insurance would never be subject to any taxation on the whole life side because there's not a gain technically in there. Okay. Cash values and dividends create the growth. And then, like I said, 7 to 9 years, you cross over. 7 to 9 years, there'll be more money in the contract in your cash value and dividend pool than premiums total paid. And you'll still be paying premium, but that cash value and everything will be growing substantially more. And the longer you live, the faster that growth because dividends are compounding on dividends and cash values compounding on cash value. Okay. Um, it's guaranteed. It's guaranteed other than the dividends. Dividends are not guaranteed, but there's 100-year track records. There's many mutual companies that have a 100-year track record or more, 110, 115 of paying a dividend. And you could see how much they paid. Okay. Most of the companies that I've done business with or work with, they're all in the range of 5 to 6% on their dividend payment, and they do it year in, year out, year in. And it grows a little. Some years is better than others based on what's going on in the marketplace and their experience. Okay. But as long as you pay your premiums, okay, as long as your premiums are paid, your contract's guaranteed, right? On the UL side, Universal Life, the chassis of the body, which is the death benefit, it's annual renewable term insurance. And as I said, that grows, that grows every year. Doesn't mean a whole lot when you're young, but as you live longer and you get older, you get 60, 65, 70 years old, that is a serious, serious amount of premium. Okay, that's a serious cost basis, which is going to dip in, it has to dip into your cash value if you're still paying the same amount of premium you were going to pay. And if you didn't overfund the contract, okay? Which means you could come to the point like what happened 10 years ago when UL policies blew up because of all the flexible premium and insurance carriers no longer had enough cash in the policy to cover the premium, and people had to go back and pay their premiums, okay, or lose their coverage. There's administrative costs and expenses. They're all reasonable. There's nothing out of whack with that. Okay. The premiums are designed to be higher than a term insurance policy itself, if you were just to go with straight term insurance. And the difference is placed into a cash component that receives interest rate or the index return. Same animal, but using a different vehicle. The index is something the company buys options on and invest into the option world, and then basically they get a return on the index, and then they share a portion of that return with you. It's not them actually investing in the market. Okay, and like people say, you have no downside on that because if the index is negative, your money does not go negative at all. So what's ever in the pool of your money, if the index was zero is the level. You never go below zero. So nothing's going to um, mitigate, or tip into your cash value pool. It's not going negative at any point. It's only going to grow. Both types of permanent insurance are by design an excellent risk solution. Okay. That's what I was saying earlier. I like to say I have trained and developed hundreds and hundreds and still got Financial Concierge University. And I work with agents who are willing uh, to be fully transparent, understand a process and how to best help a client, okay, and not be concerned about themselves. Um, Sadly, that's not always the case. The industry, is what have you done for me lately? And they all want, you don't go out and hunt today and you don't kill it. You usually don't eat. And therefore it creates just sometimes it creates a bad mindset, right? So talented financial concierge is going to be able to contrast both options for you. The IUL, the index UL, the whole life dividend paying, only participating policies. Forget about non-participating policies. Okay, if you're going to do non-participating, you go to the IUL. Um, if you're counseled on comparing permanent life insurance to any investment, you need a new agent. Okay, you need to speak to somebody else. You need to speak to somebody who fully understands, fully transparent, and it does not get down the rabbit hole of creating the comparison between life insurance and an investment. The industry does this on their own. They not only teach and train agents to do this, they send out literature that actually talks about it. Believe me, it's a miscommunication. It's not an investment. Not of any sense. It's not an investment, shouldn't be compared to an investment, but it can do things an investment can't do. That's for sure. Okay. Should it be the only thing you have? No. You should have life insurance properly designed, properly structured, and that should be a wonderful vehicle and asset class. You should have real estate, that's an asset class, and you should have investments, whether it's going to be, mutual funds by design or it's going to be um, managed money or whatever sense, you're going to go in the stock market on your own. Whatever it is you're going to do on that risk side, that's another animal, and you should have it. It should be in your basket of financial growth. Everything should be in that basket. Okay. So there's no reason to compare one to the other. But if you only have the limited dollars, you need to protect your family for the future income. Because if you only got the limited dollars, you can't put it into investments and then hope for the best, because that means, once again, you didn't cover the risk of not living long enough to bring that income in. And that's the core of the whole issue. Okay. Never, never fall into the trap of comparing a unique asset to any investment. Okay. It's just not, it's apples and oranges, should not be compared. Investments are for growth and or income or both. Okay. Permanent life insurance is protecting that growth and income by creating a long-term financial independence. So basically, you're putting money away so that it would grow, and you're putting money away possibly so it might come into income over time. But that needs to simmer. It needs to cook. But here's the problem. That requires you to have the income to put that money in to the investment. Life insurance, on the other hand, is protecting the fact that if you're not able to put that income in for a lot of differing purposes. It could be the chronic illness, it could be critical illness, it could be terminal illness, or it could be death. Okay. But if you're not able to accumulate that income, then the life insurance component is also giving your family back that income in case it doesn't happen. And the longer you live, guess what? The living benefits of the contract kick in. So you do create tax-free income, tax-free liquidity. You do create a lot of things. So from a long-term perspective, life insurance is a magnificent tool. It's just a magnificent tool. On a short term, there's nothing they can do what life insurance does in the short term. You go out tomorrow and put $100 into a mutual fund, you got $100, right? You died, I like to say you died yesterday, but let's say you put the money in, you died yesterday. Your family gets back $100. You put the $100 into the life insurance, and potentially you got 100,000 or more. So you passed away yesterday, your family gets $100,000. So that's a major, major difference that seems to go by over everybody's head. Well, there you have it. I hope this primer has helped people. I really do. I hope it's broken down some of the confusion, some of the things that people like to say are just too complicated. It's not, okay? I think it's pretty simple, really, but I've been around it for 44 years, but again, I think for the average household and for the average business owner, these are very important discussions. So you can always contact me. I'm always doing consultations still. I train financial concierges, as I said. I got them all around. So wherever you are, I can also connect you with one of mine. But you can reach me at 321-947-3220. I got advocacybz@gmail.com. Feel free to email me anytime. Check out the middleclassmillionaireplan.com. The book Middle Class Millionaire Plan is there. You can download it right off the bat. Just put in a little info and bang, you got the book. LinkedIn, you'll find me at linkedin.com, /in/Carl Schilling. So you can find me there. And on YouTube, I have at Carl Schilling 1581. There's a lot in my YouTube library. Some is public, some is private. But one thing you can look for in the YouTube library is a course that I did called Financial Transformation. Used to charge little over $300 for that course. And now I put it out on YouTube for people that it's still very timely. And I give that away to you. It's my gift to you, okay? So when you go into my YouTube channel, you look for playlists, and there'll be a playlist for the course. It'll say course, financial transformation. It'll have the whole course there. It's about 64, short videos in 8 modules, and it's all there for you, okay? And that's my gift to you. I hope you enjoy that. So feel free to contact me. You know where to find me, and certainly I'd love to have a conversation with you. And if you ever have any questions, even just questions about life insurance, we don't have to. Consultation is not arm twisting. It doesn't mean we're going to do anything. But if you just want to talk about certain things and you just want to get some reasonable advice and direction, I'm always available. Okay. So let me just stop the share here so I can see you and say thank you so much for participating with me. And I hope that this is valuable. If so, please pass it on to others and let them see this. And I think this is a good overview. Maybe will help a lot of people start to understand the true dynamic and value of life insurance. Okay. All right. Well, you guys have a great day. Again, thanks so much. And everybody be safe and happy. I will kind of commit to a time log on this. So have a wonderfully abundant, blessed Thanksgiving, because that's when we're doing this right around the Thanksgiving holiday. Okay. Thanks so much. Take care.